So let's now take a look at time frame synchronization. Before we can use time frame synchronization to determine the drawing liquidity, we need to first know how to spot institutional order flow. It is crucial that you understand this because without an understanding of institutional order flow and/or narrative, you will get caught up in chasing price patterns for the sake of chasing price patterns. It will make you just a new retail-minded trader. It would just make you a bull flag or whatever animal pattern you might use trader. That doesn't matter. It doesn't matter that the pattern occurs. What matters is that the pattern occurs at a very specific point of interest at the right point in time during a time of interest. That's what matters. So how do we determine order flow and narrative, really? First of all, we can look at the news and the general market sentiment. We know that when markets are going higher and when the news is becoming very bullish, euphoric, so to say, we should be cautious because we know that news gets utilized, or that leg higher gets utilized for smart money to open short positions against, to sell against. So when the news turns bullish and price is near or at premium race being premium breakers, premium mitigation blocks, premium inefficiencies, premium balanced price ranges, premium volume imbalance, etc., premium liquidity pools, we should be warned because we know that they use that news for manipulation purposes. When the news turns bearish and price is near or at discounter race, we should also be warned. Discounter race coming in the form of, for example, discount balanced price ranges, discount breakers, discount mitigation blocks, discount imbalances, BCs to be precise. And we know that they utilize that news for manipulation purposes again. So when the markets are dropping, we want to be looking for signs to justify looking for buy signals if the higher time frame order flow is bullish. So let's take a look at the same schematic again, but let's now add another variable to the sequence. The variable that we've now added is the following: news. As we can see, during the sell side of the curve, news gets released. This news gets utilized to send price lower into our point of interest during our time of interest. This news gets utilized for the final repricing lower before the real move is allowed to occur. And that's something that a lot of people seem to not get. Many people that have been trading and they have been investing, they have been active in the stock market, etc. We also ask them the question, what usually happens when positive news comes out? What follows? Well, usually they say the price begins to start dropping. So what happens when bad news comes out? Well, usually the price begins to start rising after a period of time. So that means that initially there can be, if the news is bearish, a leg lower. But that leg lower follows that higher time frame order flow into that price level that we've been waiting for, and from there on a buy program unfolds, sending price higher. And it's funny to realize that because then it makes sense how the whole smart money paradigm sets you free from all retail minded traders their beliefs, because they look after the fact why something has happened. We look on the right side of the charts, that blank area that no one has ever seen or touched. That's our goal as smart money minded traders. If we take a look at the market maker sell model schematic that I've been utilizing with you so far, we can see that there's a leg higher, and near the end of that leg, near the reaching of our point of interest, News gets released during a time of interest that sends price higher into that price level that we've been anticipating and waiting for. And from there on, a sell program begins and price is distributed lower. So again, the function of the news was to send price higher. Once more, trap retail-minded buyers into believing that the markets were going to continue to rise. Boom, lower time frame, break or mitigation block formation during the right time, and there it goes. Smart money reversal confirmed. And here's an example of that. As we can see, this is an article of Reuters, however you pronounce it. And what we can see that on the September 20th, 2023, they wrote an article saying the dollar index on the verge of forming a bullish golden cross, the Bank of America says. So the Bank of America is a pretty substantial bank within America, and they said that the dollar index was likely to form a very bullish retail-minded pattern, so to say. If we take a look at the dollar chart in a bit and see when this news article was released relative to where dollar was at, and we look at it from the perspective that I'm teaching you to look at the markets from, a light bulb moment should go off. At September 20th, that article came out from Reuters. It was inside of this candle here on this day that article came out. Notice that afterwards there were only about 10 candles that were still inside of an uptrend. And from there on, a monthly CB gets reached, that CB that we discussed. And from there on, the sell side of the curve unfolds. And what I'm trying to prove to you here is the following. The moment that, so to say, legitimate sources or reliable sources or governments come out and they say something that is against our higher time frame idea of what should occur, it's the best confirmation tool that we can utilize because we know that they manipulate these markets and they utilize the news for repricing purposes. So therefore, I suggest you to just go into your own charts and see when certain things were said and what was followed. Because if we think about what occurred in 2020 when the C virus came out, I'm not going to say it out loud because then this mentorship platform might be shadow banned or something like that. I'm not too worried, to be fair, because it's our own platform, etc. We're not depending on any sources, but still I'm being careful with saying that because we know how it goes on the internet nowadays. Because that C virus came out, we saw the markets drop for a few months. There was panic. People were like, huh, what's happening? And blah, 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 all of that stuff. However, what followed was one of the most explosive bull markets or higher repricing events that occurred in the past decades. So what we can take away from that again is that the news gets utilized for repricing purposes, and therefore we can anticipate news as well to come by simply looking at the charts. What happens is already priced in, and the news comes after the fact. And I'll let you think about what that really means about how controlled and engineered this world really is. Secondly, to spot institutional order flow, we will be looking at the relationship of the PD arrays that get created and act as support or resistance, or fail to do so. Within bullish order flow, our eye is drawn to a blue shaded box here on the left side of the curve, on the sell side of the curve. Inside of that blue shaded box are inefficiencies, CBs to be precise. The market reprices into our point of interest, into our price level during our time of interest. Boom, market expands to the upside. And because these CBs are failing to act as resistance on price, meaning the market doesn't retrace into that CB and then continues lower, because it fails to occur, because those CBs fail to act as resistance on price, it's a sign to us that a change in the state of delivery is occurring or has occurred. Because if we take a look at, or if we think back to the example that was shared prior with you with regards to the market make a buy model on Nasdaq, and we think back to that CB that got created, then a high formed inside of that CB, market was sent lower. After reaching our point of interest, the market traded above that CB, and now that CB began to act as support on price moving forward. The reason why that's important to note is because if the market would be bearish, that CB would not get broken, it would not get violated. So if it does get broken, as we can see occur, then we can say, okay, now buy side is likely to be the draw next. But only if our point of interest has been reached during a time of interest and we see the confirmation signs that we will be looking for. And here's another example. What we can see is that there's a CB on the left side of the curve that got created here. A high formed inside of that CB. This is that same price example again, by the way, but annotated a bit differently. What we see is that that high gets created inside of that CB. Price gets sent lower afterwards, purging the low that was utilized to even create the high in the first place. Then the market reverts, and from there on, a buy program begins. But what confirms the buy program? Well, if we take a look at this price action and we see this CB, this is the most significant CB inside of the final leg lower to my eye because this high formed inside of it. So the moment that price breaks above that high, I want to see the candle of that high be utilized as support moving forward. And the fact that price broke above this CB signals to me, okay, there's a willingness for the market to now move higher. And if we take a look at all of the CBs that followed afterwards, or I mean the CBs that got broken afterwards, we can see a CB here fails to act as resistance on price. Price breaks through it, boom, begins to act as support on price. Next CB, up here, price breaks through it. Here, boom, CB begins to act as support on price. Next CB, here, price spends a bit of time in it, but eventually breaks through it. And then that CB begins to act as support on price. So what I'm showcasing to you is that we need to look at the left side of the curve in order to determine how the right side of the curve is likely to deliver. I will go more on depth in this later because we will specifically look at the left side of the curve to also justify entries and trade management. However, for now it's important to note that the moment that the imbalances on the left side of the curve begin to fail to act as resistance on price, we need to be warned and we need to anticipate higher prices to occur next. So if we're taking a look at bearish order flow or the market maker sell model, our eye is drawn to BCs that form inside of that final leg higher, targeting or price level or point of interest. The moment that those imbalances get broken, get violated, we will be looking for a change in the state of delivery to have occurred, and therefore sell side delivery is likely to be next. Because if the market was going to continue higher, it would retrace into those BCs and then continue higher. Here we are again on the dollar chart, and what I've done is that I've annotated all the BCs and extended them to the right. All the BCs that are significant to my eye and that are easily spotted by you. What we can see is that the highest BC here got broken through, and notice that all the bodies closed inside their price range. There were a few wicks above it, but the wicks do the damage and the bodies tell the story. What we then see is that this BC is also relevant. Why this BC specifically is because we can see that a real significant row formed inside of that. Same can be said about this BC here. Next BC is here. And notice how price is first finding support in or at those BCs, retrace, boom, gets broken. This BC again, market trades into it but completely overshoots it. Market trades into a lower BC as well. This is where short-term low gets created. Market retraces, look at the bodies closing below 50% of that inverted fair value gap. Boom, sends lower. And the reason why I'm showcasing this to you is because of the following. I want you to see how price is moving through those imbalances on the left side of the curve and how it's referring to those imbalances on the right side of the curve. This is what we mean when we say that the left side of the curve influences the right side of the curve. And this is how we can gauge institutional order flow. So we have come to the end of the order flow lecture. I want to give you some homework. I want you to go into your own charts and study all of the times price reached a POI that you deemed to be relevant and PD rays began to fail to act as resistance or support on price. If you are looking at market maker buy models, your eye should be drawn to the CBs on the left side of the curve to see whether or not they're acting as resistance on price going forward. If you're studying market maker sell models, your eye should be drawn to the BCs that form inside of the left side of the curve and their unwillingness to be utilized as support before being sent higher. You should study at what time or what time interval this reversal period occurs, in which the imbalances begin to fail to act as support or resistance on price and the market begins to show signs of reversing. I want you to collect at least 30 plus charts that have been annotated in depth before watching the next lecture of the model series. The next lecture will be about point of interests. We will create this mechanical rule-based model step by step. I want to thank you for watching this lecture. Be safe and I look forward to welcoming you within the next one soon.